You may have already heard of this, but there's an ETF right now that is paying a 50% dividend. Yes, that is not a typo. That is not a misquote. It is an ETF, and as a matter of fact, it is actually related to Tesla, or Tesla is supposed to be the underlying stock that it is tracking. Now, of course, I'm talking about the Yield Max ETF called TSLY, TSLY. That is the ticker symbol. So obviously, you're coming to this video curious about whether you should invest in TSLY, whether it's a good investment, especially given that it has an extremely attractive dividend right now. Lucky for you, in this video, I'm going to explain 5 things. We're going to take a look at the holdings within the TSLY ETF. We're going to talk about why does it pay such a high dividend. Finally, we're going to look at its performance, especially compared to Tesla. And lastly, we're going to discuss, should you invest in TSLY? And if you stick around to the end of the video, I'm going to be giving you a potential options play that you can try out with TSLY if you decide to invest in it, and this could supercharge your investment. So let's get right into it. Number one, what is TSLY? TSLY is an ETF by a company called Yield Max. Now, you may have heard of them, but Yield Max has an array of ETFs, and they are all basically designed around producing income. TSLY is the more popular of the bunch, but they have one that's tied to Apple, Nvidia, Amazon, and it goes down the list as you see here. Now, as of the time of this recording, October 8th, TSLY is currently trading at around $14. To be specific, $13.85. And if you take a look at its last few dividends, it pays dividends on a monthly basis. You'll see that the dividend varies greatly, but is rather high compared to a stock that is this price. So TSLY is a managed fund. It's an ETF that aims to produce income from investing or speculating in the underlying stock, in this case, Tesla. So now let's take a look at what's actually in the fund itself. Now, if you take a close look at this, you'll see something that might seem very strange to you. It actually doesn't hold any Tesla. If you look here, it is actually short the 270 put on Tesla expiring November 17th. Currently, it holds US Treasuries, which a lot of people find weird, but we'll talk about why that is in a second. It holds a ton of Treasuries. Here you could see that it holds almost 400 million of the November 15th, 2024 0.75% Treasury and almost 400 million of the December 31st, 2023 0.75% Treasury. We're going to talk about why that is. Then it is short a couple of calls, the 265, the 270, and it is long the 270 calls expiring November 17th, and just a little bit of cash at 120,000. That's all that's in this ETF. That's it. There's actually no Tesla to be found. So how does it actually pay out such a high dividend? Well, in order to explain this, I have to explain what is a covered call ETF, because these Yield Max ones are not the first of their kind, but they are certainly the most creative. And let's talk about why that is. So you may have already heard of covered call ETFs like JEPI, JEPI, or JEPQ, JEPQ. These are basically investments in something like the S&P 500 in JEPI's case, or the NASDAQ in JEPQ's case. However, they are also meant to generate income, and they generate income by selling covered calls. If you look at JEPI's YTD dividend, it's 3.67%. If you look at JEPI's 30-day yield, it's actually at 7.9%. So real quick, this is how covered call ETFs make money. Let's say that the ETF invests in a stock that's worth $100 and it sells the $105 covered call. And let's say it does this for $5. Again, we're talking about an arbitrary stock here. So that means that if the stock never gets to 105 by the expiration date of that covered call, then the fund gets to keep the $5 that it sold this for, and this expires worthless. Just like when you and me sell a covered call. So then the fund takes this $5 that it just made on this covered call and distributes it to its holders. This is how JEPI or JEPQ gets their dividends. Obviously, this is a very simplistic approach. They are doing this with hundreds of millions of dollars, selling a number of calls at different expiration dates. But if we take a look at the Yield Max ETFs, and specifically the TSLY ETF, you could see that what they are doing is they're not even holding the stock. They are doing what is called a synthetic long. So if you look at the prospectus here, it says a synthetic long exposure to Tesla. The fund will buy Tesla call options and simultaneously sell put options to try to replicate the price movement of Tesla. So a synthetic long, which you can achieve on your own, irrespective of this ETF, you can buy a call on a stock and you can sell a put, and it will give you roughly the same long exposure as buying the stock, but it is cheaper and you could do so on margin. So this is the way that TSLY actually produces a much higher income than something like JEPI or JEPQ, where they are just selling regular calls against the shares that they are buying. In TSLY's case, they're not even buying shares of Tesla. As I showed you here, they are actually engaging in synthetic longs by buying calls and selling puts. And you could see the long 270 call, both for the same expiration dates. And then they are then selling covered calls against those synthetic longs. So you can see here that they sold the 270 call expiring October 13th, and they sold the 265 call expiring October 13th. You can see the minus symbols on both of these. And the reason that they hold treasuries is because you need collateral in order to do this. You cannot do this without cash. If you're not going to own Tesla shares, in order to do synthetic longs and sell covered calls, you actually need collateral. However, instead of just holding their collateral in cash, which doesn't earn anything, as you can see, they have very little cash here at 120,000. What they're doing is they're buying short-term treasuries that are actually yielding them an additional yield. That is why when you finally get to the fund's monthly distribution, you'll see here it says writing call option contracts on Tesla as described above. The income in the form of option premiums received from such option sales will be primarily influenced by the volatility of Tesla stock, although other factors, including interest rates, will also impact the level of income. And there's a secondary way in which TSLY holders earn their dividends. Investing in short-term U.S. Treasury securities, the income generated by these securities will be influenced by interest rates at the time of investment. So it says here the fund will seek to provide monthly income in the form of distributions, and those distributions will come from these two things, the covered calls and the short-term treasuries. All right, so now the big reveal. Let's take a look at TSLY's performance in comparison to Tesla. Here in blue, we actually have Tesla, and here in orange, we have TSLY. Now, it's important to note that this includes the dividend. So this isn't just the stock price, right? This isn't just the NAV, the net asset value. We are talking here about the dividend, in addition to any gains that the stock price of TSLY may have gained or lost. Now, it's also important to note that TSLY hasn't even been out for a year yet as of the time of this recording. I'm recording this on October 8th. TSLY came out November 21st, 2022. However, if you take a look that even with the dividends, with all those crazy dividends, if you take a look at year to date, you can see here that Tesla is up 140.55% on the year, and TSLY is up almost half that at 71.27%. So obviously Tesla has had a crazy year to date, because if you remember, Tesla did hit a low of 101 last year, and now it is currently trading back in the high 270s again as of the time of this recording. However, it's important to note, if we track these two charts, is there ever a point in time where TSLY is significantly more money making than Tesla? The comparison, almost at no point is TSLY above Tesla in terms of gains. Now, there is an important moment where Tesla is actually down and TSLY is less down, but it doesn't mean that Tesla actually has astronomical payouts when Tesla goes down. The only advantage that I can see here comparing these two charts is that when Tesla is in the toilet, Tesla tanks by a little bit less. It's not even that much more significant or that much less significant. So finally, should you invest in TSLY? And here is my final verdict. For the most part, I think that TSLY is actually a dividend trap, as you can see here. Yes, it pays out nice dividends, but if you compare it to the thing that it's actually supposed to be tracking, which is Tesla, it does a horrible job compared to Tesla. Also, it's important to note that TSLY does not actually invest in Tesla, so you have no real Tesla exposure. It's just speculation using covered calls, synthetic longs, and US treasuries. But there is a time where TSLY could be a little bit valuable, and that's if you expect Tesla to be very flat, or you expect Tesla to have a drawdown in price. So as I said, I misspoke a little bit earlier. Tesla's currently trading in at 260 as of the time of this recording, not 270. But if you expect Tesla to, for instance, let's just say revisit that 101, which I don't think will happen, but let's say that you expect Tesla to revisit that 200 level and then remain stagnant until next year, because maybe it's going to increase its delivery numbers, maybe it's going to do better in China, maybe the release of the Cybertruck and some other features boost the sales of Tesla. So you expect maybe Tesla to have a stagnant year, especially if you're expecting a recession. Again, as of the time of this recording, October 2023, maybe you're expecting a recession. Those are decent opportunities to earn a high amount of income on something like Tesla. But in my opinion, it should not be a part of your Tesla exposure or a significant part of your Tesla exposure. You should still invest in Tesla if you are interested in that company, and then maybe use 10 or 20% of that to invest in something like Tesla if you are expecting stagnation or a downturn. And I just want to add one more very important point, is that covered call ETFs, like I said, they've been around for a while. And if we take a look at one like QYLD, which is a NASDAQ covered call ETF, this has been around since 2014. So we have a lot of data, much more than Tesla. Covered call ETFs are going to suffer from something called NAV erosion, net asset value erosion. And if you take a look here, the QYLD was trading in the mid 20s, around $25, $26 when it first came out. And now it's trading at 17. And remember, I said this came out in 2014. Now, how can that be down when the NASDAQ is up 360% as of the time of this recording since 2014? It's because of that net asset value erosion. See, these covered call ETFs have to continue to pay out their distributions based on the premiums from the covered calls, and that lowers their net asset value. And every time they pay out distributions, that net asset value erodes until they finally have to do something like possibly a reverse split. So in the long term, you definitely don't want exposure to the covered call ETF, choosing that over the actual stock, especially if the stock is something that is expected to trade at much higher values in the future, like Tesla or the NASDAQ, etc. Now, there is one strategy that I like for the short term. Again, if you are only going to be trading Tesla and it's not a majority portion of your Tesla exposure, and you're expecting some sort of stagnation or drawdown because of a recession, and that is selling a covered call. So you're buying Tesla and you're selling a covered call as well. And I know that's like covered call on crack because it's already a covered call ETF. But say that to take advantage of that potential NAV erosion, if you bought Tesla right now at $13.85, you're going to get 50 to 70% dividend. So you're going to get paid that in the short term, right? This is annualized, obviously. And then also you can then sell a covered call. Like you could sell the $13 covered call for $135, and you will collect $135 for every covered call you sell expiring in May 2024. You could sell one of these for every 100 shares of Tesla you buy. And that just adds to the income and also prevents some of that NAV erosion that you might experience from now until May. And one last note that I want to say about dividend traps is that remember that don't buy a stock just for the dividend. In this case, you might speculate on the short term based on the popularity of these yield max ETFs right now, but don't heavily invest in stocks just for the dividend. Make sure that you like the stock first, and if they pay a dividend, then that is the cherry on top. That is actually what a dividend is supposed to be. Too many times you see these noobs on YouTube or on Instagram or Twitter buying dividend stocks without even knowing what the stock is, just because they're like, high yield, okay, I'm going to buy. But they have no idea how dividends work, the fact that companies are not required to pay a dividend, that they can actually change their dividend structure at any time, that they can pull dividends, that they can lower dividends. And in this case, we don't have any evidence of it, but Yield Max can actually change the prospectus on some of these dividend ETFs. So also just be careful about that and make sure that you are kept abreast about the most updated prospectus for the dividend stock or ETF that you want to buy. And one more thing I forgot, I'd be remiss if I didn't talk about the expense ratio. Obviously, this is a very active fund, meaning there's someone behind the scenes that is actually doing these synthetic longs and selling the calls, and then selling the calls when those calls expire. And then, what if you get assigned? You now have to then offload those shares and then sell more calls, etc. So in this case, the expense ratio is pretty high for an ETF. It's almost 1 full percentage point, meaning that for every $10,000 you invest, you are going to be paying $100 a year in order to hold Tesla. So just keep that in mind when you figure in your cost calculations. Anyway, traders, I hope this was helpful. If it was, give it a big fat thumbs up. Let me know that it was helpful. I personally think that it is the best video on this topic, but let me know what you think. If you want access to our vibrant trading group, we have 3 analysts. We talk about day trades. We talk about long-term hold, swings, cover call strategies, cash secure puts, iron condors, option day trades, futures day trades. Talk about treasuries, oil, etc. The whole gamut, stock market analysis, a current update of the entire market and economic landscape. You want to join thousands of traders who are in the know. Link is in the description below. If you see a coupon code, consider yourself lucky. Make sure you use it Do not pay full price. If you're interested in joining our next mastermind, that link is also in the description. Get yourself on the wait list. Do not miss out. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.